Welcome to this video about financial analysis focusing on the earning capacity. The earning capacity is showing us and how the company is able to make profit out of its activities or out of its turnover. And we use various ratios, key ratios to go into the reports and analyze that. But before we do that, I'd just like to draw your attention to the income statement or the profit and loss statement, because this is made for the purpose of analysis. So now we're talking about an internal setup, whereas normally when we talk about financial reports, when we read them on the internet or from our competitors or whatever we download from the internet, of course these are official external reports made by the restrictions of the law. So there's two different things: the external financial report, which is made to report externally, and of course the value of information in the external report is not very high. Some public limited companies actually don't even tell their turnover. So you more or less have to guess how big the turnover is in order to make an analysis of the earning capacity of the activities. And also another thing, this line here, other external cost, you will see that when they have included their turnover, you will see that other external costs are put together with the variable cost. So the gross profit in the external report is a profit where all variable cost and a lot of external costs actually has been deducted. So that's two different things from what we are doing when we are doing financial analysis on earning capacity based on the income statement made for analysis purpose. So you will see here that of course we have the turnover, and we have actually also divided the contribution margin in 1 and 2. Sometimes, very often though, companies only show one contribution margin, but you can do it like this in gross profit, where only the cost of the product itself is deducted, and then other variable costs next to that is deducted. Other variable costs could be bonus for salespersons. They're part of their salary that they only get payment if they make a sale, so it's a sort of provision. Packaging costs, which comes whenever we are selling products, and so are quite often other variable cost next to the product itself. So, and that gives us the contribution margin. And then we have all the fixed costs and giving us the earnings before interest and tax. This is also what we call the operating profit. So it's just to say that we are talking about two different things: the external profit and loss account, which can be analyzed as well, but normally we would like the internal statement to analyze the situation in the company. And of course it's also used to manage the company, to find out where should we make some actions, because you must remember that an analysis internal in the company is used not only to generate knowledge, but also actions based on this knowledge. Okay, so this is an internal income statement made for the purpose of analysis. Let's go to the analysis itself then. The first thing we would like to see is actually the operating margin, or the operating profit margin. And this is a key ratio which take all the capacity costs and all the variable costs. So this is the major information: how much earning do we actually make in total in percentage of the turnover. Okay, and you see the formula here. Gross profit percentage is just the percentage of the product itself. So if, for instance, we have, and that's quite normal in many companies, that they have a lot of different products, and probably some products will have a higher cost profit percentage than others. So we can go down actually not only to calculate the total from the income statement, but we can also look at the various products or the various customer segments or sales areas, or how we, let's say, divide our company, structure our company. But here we take it in total. And the contribution margin is, as I said before, where all variable costs has been deducted. And be aware that I use terms as turnover and revenue being the same thing. So these key figures here are very important when we talk about earnings and earning capacity. These are the things that we want to adjust. And of course, generally we want them as high as possible. However, we must also consider the volume of the turnover. So sometimes we can accept that we go down in profit percentage if the volume is high, because at the end of the day we are living off earning profit measured in money, not in percentage. So that's why sometimes you see when you have a high purchase, you want a discount, but this is, politics and tactics about the trade, which is calling for another discussion, and I'll leave that for this. We're just talking about the techniques now on measuring earnings capacity. Okay, fixed cost ratio is telling us how many times the contribution margin, so after all variable costs has been covered, how many times it can cover the capacity costs. Of course, when we're talking about development over the years, we would like to see that in percentage or using index numbers and compare the variable amounts in the report. How are they developing in the index? The two down here below, the break-even revenue, is quite important when we are talking about budgets and starting up a new business. Then, of course, we would very much like to know, well, how much should I actually sell in order to break even? Just to get a picture on how feasible is it to make a profit. Okay? Safety margin is when you are in business and you have a profit like you have here, how much can you actually afford to lose? How safe are you in this type of level? How much can you actually risk to lose before you will go into zero or to break even? So we'll come back to that when we calculate the numbers. Okay, so I'll just change this here to solution. Let's calculate the numbers now. The operating margin, the king of earning capacity analysis, is showing us what is the EBIT in percentage of the turnover. And I have already baptized, so to speak, these cells down here as percentage. So they automatically multiply by 100 and name the cell as a percentage. And here, earning before interest and tax, I think I'll just put in here that it's operating profit. So there's no doubt about it. Okay, and I can copy it to 2017, and instantly we see this situation here that the operating margin is going down. Okay. However, be aware that the profit has increased, but taking as a share of the turnover, it has gone down. So this is a little bit of the dilemma that I talked about earlier about politics strategies, increasing sales, and the level of earning that you generate from the sales. But all in all, from this point of view here, it's of course critical to see that it's going down, right? As a business manager, we want increase in sales and we want increase in profit margin. And of course, it's not easy. That's why you are going to manage it. Okay. The gross profit percentage. Well, that's talking about the gross profit measured only on the sales price and the cost price of the sold goods in this internal analysis here. So we will look at the profit or the contribution margin 1 divided by the turnover. Okay, so this is a much higher percentage. So the purchase and sales on the products having a profit margin of around 45% and declining quite a lot actually compared to this 0.6 points decline. Here we have, what is it, 2.2 percentage points decline. So actually we can already now see if we are going to do some actions based on our analysis here, it is not, perhaps not down here in the fixed cost, we will look on other variable costs, it's actually up here in the daily business trade that the operating margin reduction is taking place. So it's the daily trade, sales price, purchase price on the sold goods where we have to look at. So we have to talk with our salespeople and purchase people and, you know, the product mix, many things we cannot just make a conclusion on it now. We have to do some interviews, but we have a signal that it's here in the top we have to look. Okay, and contribution margin ratio, that is, or CM2, that is contribution margin divided by, yes, right, turnover. Copy that over here. Okay. No, that was not the way to do it. Okay, fixed cost ratio. Well, this is telling us how many times the contribution margin can cover the fixed costs. Hopefully more than once. We'll see about that. I'm used to not to start by the sign equal. I'm used to just to say plus very often because that's only one way to pressure. If you pressure the equal, you have to pay swift and then above the zero. But it's just my old habit here. So fixed cost ratio. Well, I have to take the contribution margin and divide it by all the capacity costs. Okay, the capacity cost. I'm not taking tax and financial costs. I'm just calculating down to earnings before interest and tax or the operating profit, because it's the operation of the, let's say, the company that we are measuring. The finances is, you know, depending on how strong is the company in its financial structure. So it's not the pure operation we are measuring if we take in the financial cost. And tax, well, some would argue that tax is not in the accountable way a cost. It's a share that we pay to our society from the profit that we make. Cost in the accountability and in financially speaking, costs are meaning cost which is necessary, which we use in order to generate a profit, right? And tax is not necessary for us to generate profit. It's payment to the society. So it's a part of our profit that we, I think I've told you before, it's divided into three. The society gets first, and then the company, and then the owners. But that's another discussion I'll come back to. Fixed cost ratio here is 1.34, going down to 1.33. Index, well, index, normally I would say index, we calculate that when we have several years to analyze the trend, but I'll just show you here how to calculate index numbers. And the formula of that I have shown up here. It's the year figure, so the running year, so to speak, divided by the basis, divided by the first year. And of course, it will be 100 for the first year. So I'll just show you. Index for turnover. It's telling us the development rate over the years of, in this case, the turnover. So I will say turnover multiplied by 100 divided by turnover. And strangely enough, it's 100. It's just to put it on a basis so we can see how does it develop over years. Now I can say I take the actual turnover for this year, for the actual year, multiply by 100, divide by the basis year. Okay, so we can see it's increased about 21%. The same thing for capacity cost. So I will say capacity cost multiplied by 100. And divided by capacity cost again in the basis year. And this will be 100. And the same thing I'll do over here. But now I take the new year, and if we had more years, I will always divide by the same basis year so I can feel the development over the years. Okay, so index for capacity cost totally is 115. And here also we can see this is actually giving support to my first impression that it's in the top lines, the sales and the cost of goods sold, that we have the problem, because we can see that the turnover, the activity, so to speak, in the company has increased to index 120, 21%, whereas the capacity cost hasn't increased that much. So that's positive. That's positive. Be aware, traditionally, we see that the capacity costs are changing slower than the turnover. And this is, of course, a good thing when we increase the turnover. However, if we see a decline, we will see that normally that capacity costs are not declining in the same ratio because it takes time to change them. Okay, but a good thing here that capacity cost is, you know, slower in increasing, and it supports the first impression that sales and purchase, we have to look at that. Now, break even revenue. Well, how do we calculate that? How much must we sell to cover our fixed costs? Because, you know, we have to cover our fixed costs, and we'll do that by having a contribution margin similar to the fixed costs. So when the CM2 or the contribution margin is similar to all the fixed costs, then our operating profit will be zero. And the contribution margin we always can calculate by multiplying the turnover by the contribution margin ratio. That's how we calculate the contribution margin. So now I go backwards and divide the fixed cost by the contribution margin ratio, because that is telling me how much must the turnover be to generate a contribution margin, exactly covering the fixed costs. Okay, hope you got that one. So I'll take all the fixed costs, all the capacity cost. What's the difference between capacity cost and fixed cost? Well, I would say the financial cost, because financial is not, let's say, a capacity cost, so to speak, but it's a fixed cost because, you know, we divide the cost in a company into variable costs and fixed costs. And the fixed cost we divide again into financial costs and capacity costs. Okay, so I'll just finish this one. These are all the capacity costs, and I'll divide that with the contribution margin ratio, giving me an revenue, break-even revenue of 16,996. So 16,996,000. Now, some of you might say, could this be true that we can have a break-even if we sell with a turnover, a revenue of 16,996? And I can prove it because we know that we have a contribution margin of 43% of our turnover. So now, if I just take this one here and multiply by the contribution margin ratio, I will generate if I have this turnover, I will generate a contribution margin, CM2, of 7,337,000. Just for the fun, I will now just calculate what is actually our capacity cost. Whoa, 7,377,000. So the break-even revenue is indeed 16,996. So how much can we afford to lose from this actual turnover in order not to make a loss? Well, we can calculate our safety margin, and that is the actual sales, as we have the formula up here, the actual revenue, sorry, not the actual sales, the actual revenue or the actual turnover. So the actual sales, actual revenue, sorry, minus the break even. So this is, of course, our safety. And if I just left it here, I would have the safety margin in kroner, because this is in 1,000 kroner, so I'll have the safety margin in 1,000 kroner. However, I wanted percentage, so I divided by what? Our starting point, the actual the actual revenue. So I can now see that I can actually afford to lose 25% of my turnover in order not to make a loss. So that's the safety margin of our activities. This is the analysis of a earning capacity, and we've found out that it's, they have an earning of operating profit going from 2.48 to 2.83. However, the share, the margin is declining, so it's okay, but we have to focus on the top line. So how do you comment on these things? Well, I've made something for you here you can read, and it has declined. So from 2.9 to 2.3, and the operation margin has declined by 0.6%. But the CM ratio has gone down with 2.2%. That's what we saw up here. Now I just will put in an extra digit so you can see it's 2.2. However, I think we also should mention that, well, the operation profit has increased. So another way of make the analysis is to calculate the value itself, the change itself. It's always nice to have money on the table as well. Okay. So here you can see, well, we have an operating increase of 350, but the loss is very much due to an increase in the tax. Tax is quite another way of putting up the statement. You could say we have three different statements. We have the external income statement, we have the internal income statement, and we have the tax calculations. Okay, so it's just, and here you can also, of course, add the percentage change. Every, similar to what we did with index numbers. So here I just take the change and divide by the starting point, and I'll make it into percentage, multiply by 100, and put a percentage behind it. And now I can go down. So now I have all the figures, and I can see that the gross profit has only increased 15%, whereas the turnover was increasing 21%. So you can see the cost of the goods sold has increased more than the turnover itself. Okay, and we can see here that other external costs are quite conservative. So, but this is just to show you another way of making an analysis of the earnings capacity. So this was it. Try to calculate from these things yourself and comment on it. You can see it down here. I'll leave it you to read it. Okay. I hope you enjoyed it and found it useful how to, from an internal statement made for analysis purpose, how to make an analysis of the earnings capacity in a company. Thank you very much. See you next time.